Welcome to the Exit Ready podcast. Ryan Ray here as always. Today you're going to love the episode. Be sure to never miss what's going on with the Exit Ready Cohort Intensive by going to www.rgahub.com/exitready. That's rgahub.com/exitready. I'll put a link to this in the description below so you can check it out. But if you're an owner, you're not going to want to miss this. Now, let's get to the show. Will, it is nice to have you on today. How's it going, man?
It's going well. Thanks for having me.
Yeah, great. So give a quick introduction of kind of who you are, what you do, and you mentioned your background offline here, so maybe a little bit about that as well.
Sure. Yeah. So name is William Fry, based here in Austin, Texas. I'm the founder and CEO of American Operator, and we're kind of the anti-BlackRock play to preserve American small businesses with the next generation of local owners. So we buy small businesses in partnership with an operator, and then we allow them to buy back our ownership over the course of 5 to 7 years. So at the end of the day, it's majority locally owned, and spent the past 4 or 5 years in the small business M&A space. And then before that, grew up in Eastern North Carolina, where it was pretty much tobacco fields, baseball, and small business. So always been a good part of my life, and excited to be here.
Yeah, and on X, people say the term SMB, and usually they don't really mean the full breadth of SMB. And so we say small business. When you say it, let's define it for the listeners so they understand the size of companies we're talking about.
Sure. Yeah. So small to medium-sized businesses, we don't really touch medium-sized businesses, if I'm being honest.
Most don't. Most don't.
Our focus, our businesses worth anywhere from, $2 to $5 million is probably our sweet spot, our strike zone. And so that means typically you're making, anywhere from $1 million top line to $10 million top line, depending on the type of business that you're in. And a lot of folks kind of break up the market as you have kind of sole proprietorships, where it's like a guy or a girl just kind of running a solo venture with themselves. Then you kind of get into the Main Street segment where we focus, which is you got some employees. It's not just, one person, but it's not a huge scaled company. And then once you kind of tip over to businesses worth more than 10 million bucks, a lot of folks start calling that lower middle market. It's just kind of lingo that people use.
Yeah, and it's always interesting because people will throw out, I always pick it, we say SMB on X, but it's really S's mainly. Some of that lower M, it's it's not the top end of the M's is rarely what's being discussed, and so it's fine. But it kind of I think in popular culture outside, if you're on X and you go to X meetup and you talk about SMBs, people are like those size companies that you just referred, but the actual definition is way bigger.
Totally.
It's some pretty big companies, and so it's funny that we kind of have owned this moniker on X for SMB, but really it's many S's, and nothing wrong with that. Now you mentioned something there, and I want to get clarification on. You said that your buy box is 2 to 5, right? But then that might be 10 million in revenue. So how are you buying a company that's doing 10 million in revenue for $2 to $5 million?
Yeah, it comes down to margin, right? So typically we're looking at businesses that are worth between 3 to 5 times earnings. And so if you're a business that's making $10 million top line, but you're only making a 5% profit, then you're not going to trade for more than, a couple million bucks, unfortunately. And you see that a lot in, distribution, some wholesalers, some manufacturing. Typically the trades are higher margin. They're, you're 15, 20%, sometimes even more depending on the trade. But, from the outside, for folks who aren't in the kind of small business ecosystem, oftentimes you think, oh, more revenue means you must be worth more. And that's not always true. How much profit you make per dollar of revenue matters. So,
yeah, I was just talking to a guy who does valuations, and I was telling him a story that talked to some owners one time. They were really frustrated partners, and they didn't like each other anymore. They wanted to split up. They're doing 190 or 100 million in revenue, netted $1 million, and it's like, and they wanted to sell for like 100 million or 90 million bucks, whatever it was. I can't remember the numbers now, and it's like, no, it's not worth nearly all that. And that's part of when I'm talking about content and stuff and trying to help owners is help them understand that you can scale. That's great, but you got to understand the limitations of how far you can scale. But even as you do scale, if you don't have good margins and you're not, it might not be worth really scaling from 7 to 8 or to 10 million if your margins are terrible because you might not exit for that much more. You got a lot more headache. And so I don't think a lot of owners are really getting educated on what makes a company valuable, what makes
Yeah.
it easier for them to run. It's more about, hey, let's just scale, scale, scale. And I get why people push that. I'm not against that. But the reality is, for most owners, creating a valuable business, I think, is probably the path they should take.
Totally agreed. And I think a lot of times, we've involved in next week will be over 100 small business acquisitions. And the two ways we hear owners think about the value of their business is how much do I need to retire and move to Florida is thing one, or how much did my buddy who I fish or hunt or play golf with sell his business for? Well, mine must be worth more than that. And it's like, unfortunately, both those things are definitely, useful data and inputs, but they don't drive what a stranger is going to pay you for your business.
Yeah, well, and to that, the first point I would say, if you had to pick one of the two, is the most important because that gives you your target, right? I need
Sure.
to retire. I need $1 million or $5 million or whatever it is to move to Florida. Then you understand what your company. Then you go find what your company's worth, and
Yep.
then you go, okay, I'm there. I'm not there. What I got to do to get there. But if you don't know that first number, or you think you have an idea what that first number is, and even owners can undercalculate that. They might because they don't think about taxes and all the stuff they're writing off to their company now, and all the stuff goes away. They might not understand that number, and then what the company's worth, and like, oh yeah, I can go sell this thing. And then a lot of owners, to your point about what their buddy sold for, I've heard that, and I've also heard, we're close to DFW. Oh well, DFW is a huge metroplex, and there's unlimited market up here, and it's like,
Yeah.
yeah, okay. Unless you're
Yeah.
like Apple and you own DFW, or Microsoft or Samsung, your market
Yeah.
share isn't high enough in the area that you're in probably to actually say that you can tap into a huge market. And if you have a substantial market share, then you can have that conversation. But just being a small business in an area, for most of the time, they don't have enough market share to really talk about the value of the market and buyers to go, yeah, that's worth something.
Totally. And I think the other kind of thought pattern you see is future value, right? And
Mm,
so some owners are like, hey, you know, I've built a great kind of jumping off point. Whoever takes it over, they can take it to the moon,
yeah,
and you should pay me because it's so valuable. Well, if I pay you for how much value I'm going to create once I buy it, then where's the money for me?
yeah,
It's like, no, I'm going to pay you what's fair for what you've delivered so far, and you should get a pretty penny on that. But anything that I'm able to squeeze out of it afterwards is mine to earn. And so
yeah.
that's kind of another thing that you see.
Yeah, and I always tell a story. I was sitting down with an owner one time, good dude, really like him, and I said, well, if you could get $2 million, would you pay $500,000 for it? He goes, yeah. I said, okay, write me a check for $500,000. I'll tell you how to do it. He goes, well, I don't know. I'm like, right.
That's
And
great.
so, it's like, right. I mean, I can tell you, it's not that I'm a savant. I just understand how
Yeah,
these numbers work at a high level, and this is what you got to do. Like, I can tell you,
sure.
and if you go do it, it's worth $2 million to you. But you
Yeah,
won't write the check. And I'm not being, I really like this guy, so I'm not picking on him. It's just a good story. But that's how it actually works. Like, oh, so when you talk about this upside, it's like, yeah, write me a check for $2 million or $500,000 or whatever, and you could grow this thing to the moon. It's like, well, yeah, but I might not. Just like that guy might
right.
have paid me $500,000 and not been able to execute on what I told him to do. There's a huge risk there, and owners seem to think about that risk like, oh, yeah, it's easy to do. It's like, well, why haven't you done it then? Well, it's like, well,
Right.
the is what I'm buying. I'm buying the
Yeah,
that might happen to me too.
totally. Totally. That's spot
So,
on. I think
oh,
the
go
other kind
ahead.
of human thing is that I used to always love when we were more involved on kind of the sell side back a handful of years ago. I think roughly 30% of owners have an exit plan in place. Um, and also around 31% of Americans floss every morning. And I think there's a reason that those stats are so similar that you just you don't do the preventative thing that you probably should be doing. Um, and then the unfortunate part is that you pay for that at the end of the day, especially if a health issue comes up or you need to retire and find a successor quick. You don't have time to get your ducks in a row.
Yeah, I think that yes, 31% flossing. That's funny. I'd never heard that stat before. That's probably accurate. Yeah, I think you know if you're an owner of a company and it's put off a good living for you, great, man. There's nothing wrong with that, and nothing wrong with a lifestyle business. I'm not sure what I'm building I want to exit ever. I mean, I'm going to exit. Everyone's going to exit. I'm going to die or something. I'm going to shut down. But
Sure.
I'm not sure I'm building to be. But with that mindset, I know that I have to invest a certain way. I've got to do certain things because I know that the big cash cow at the end is probably not what I'm going for. I might change my mind in a few years, but if I do in a few years, then I understand that it's going to take even more time to make sure it's ready for that, right? So I understand, like, hey, but a lot of owners, they kind of build this thing. They're successful, had a great living, and then they go, oh, I want a big payday. It's like, well, no. You can get some payday probably, but a big payday takes a few years to really have yourself in position, and it could be something like customer concentration, owner dependency. There's a lot of little things that you've been running. There was a guy on X talking about taking cash and how it gets lost, and they stopped doing it. And it's like, yeah, you could be putting cash in your pocket, not telling the IRS, but you want the buyer to pay for that cash that you're not claiming. Well, how do we know it's real? And so it's I really try to, when I'm talking to owners, help them understand that they've lived in this world and they're comfortable with it. But if they had to write that check, would they write it? And that's why I use that story I did a minute ago. Like, well, you want $2 million in your business? Pay $500,000. Oh, well, I don't want to do that. Right. And so when someone's going to buy your business, the better that you have it set up, the more likely they are to pay you that $500,000 or $2 million or $3 million or $5 million or whatever it might be, because it makes more sense. It de-risks it from their perspective. And so how you view the risk as someone who lives it every day is not the same as someone who's going to write that check for the big money. Hey, quick break here. If you're an owner, do you know that most companies will never actually sell? That means that all those years that you put into building your business are for nothing. If you want to build a business that's valuable, that people will want to buy, and you could make potentially millions of dollars from, go to rjhub.com or click in the link below. That's rjhub.com, or click on the link below. And now back to the episode.
Yep, 100%. 100%. And you see it kind of shake out, in real life, where the better the business is in terms of the systems and the processes and all of that, the higher multiple a buyer will pay. And that's not to say that, like, hey, if you keep we've dealt with owners where the receipts are in a box under their bed. I'm not making that up. And if you built a good business, people will still buy the business, but they're not going to pay as much as if you had everything in QBO, and had some idea of closing the books once a month. So.
Yeah, it reminds me, there was a guy, he wanted to sell, and everything was handwritten receipts. He never put them electronically, and he couldn't even find it all. And so he was trying to get all that together. And the last time I heard, he still hadn't got it all together. And it's like, and he had a really lucrative business from what he was saying. And other people that I know that I trust were saying, yeah, it's what he's saying is true. It's like, yeah, but and it was in the oil and gas industry, and so they're going to look at it with some certain scrutiny because they want to make sure, because of just the risk of oil and gas in general, but to make sure that this is actually real. And anyways, sure. And so I think, again, you live in that world, you don't really think about, coming from the outside in, this is risky. Would I write a check for this? And so how do you help owners appreciate what you're saying when you talk to them from a buyer's perspective? Because what I say is, when you're going to sell, if your company is set up a certain way, I like McDonald's burgers, so sitting and hate on McDonald's, you're going to attract a McDonald's buyer. And what I mean by that is someone who only buys the dollar menu from McDonald's, a cheap buyer, someone who's looking for a discount. They're wanting to just beat you down over price. Or you could attract the Ruth's Chris Steakhouse person, someone who wants the premium. They want the top dollar. And so how do you talk to the owners and say, hey, I'm not trying to be a jerk. I'm just trying to say, like, right now, what I'm seeing is, here's the risk. Here's how I have to think about this. This is why instead of paying you 2.5, I'm going to pay you 1.75.
Yeah, I think it varies, obviously. The first thing that we try to do is just position ourselves in the market so the owners know what we stand for and what we're about. And it's ultimately, it's their business. Like, they have free will, they have free agency. They don't have to sell to us. We would be honored to be the party to kind of uphold their legacy, but we're not for everyone. And so kind of like our model is bringing the committed capital and the professionalism of your typical institutional or private equity buyer with a local individual who's going to become the majority owner and the CEO of that company. And so we can kind of blend the merits of like, hey, we're not trying to roll you up and sell you to some private equity fund. You're getting someone in the community who's going to go to bed thinking about your business, wake up thinking about your business. But because we're not trying to put a ton of debt on the business and grow it at some crazy rate, we can't pay these kind of fake multiples that some of the private equity buyers pay for. By that same token, you have a lot of individuals now entering the space wanting to buy a business that don't come from the industry, and they're going to use an SBA loan. And some of those individuals are great, but they're also quite risky. And you're kind of taking a flyer on, can they stumble to the finish line on doing a small business acquisition? Can they secure the capital? Are they serious? Have they spoken with their spouse about it? Yada, yada, yada. So I'd say that's first and foremost. And then once it gets into the numbers, what we want to know is like, hey, we have a limited amount of capital, and it's all on our balance sheet. So we're not going out to banks. We're not going out to investors to go ask for money on a per deal basis. And that means if we commit to you, we can close on it. No, we're not asking for anyone's permission, but we have limited shots, and we want to make sure this is a shot that we want to make. And that ultimately comes down to the stuff that you were alluding to earlier, which is what risk are we taking on, and can we get comfortable with that risk? And there are certain instances where we just can't get comfortable with the risk. And I'll give you an example. We were chatting with some owners, great couple out in Pennsylvania, about buying their contractor actually with their son. They have a couple kids. Their son works in the business, and we were going to essentially fund it, and he was going to become the majority owner for a couple of years. The thing that we couldn't get comfortable on is there was a project-based contractor, and their WIP, so their work in progress, if you look at it month over month, had just slowly dwindled down. So they knew they were exiting. It seems like they slowed their roll in terms of getting new bids out, winning new projects. And that's the opposite of what you want to be doing if you're trying to position yourself to sell. You want to show that thing growing so that a new buyer can come in and they're, boom, day one, ready to rock. And they're not starting flat-footed, because then, technically the multiple that you're going to be willing to pay for that is a lot lower. Because you don't have enough work in progress to actually hit the revenue targets that you did last year.
Yeah, it's a fine line there too, because when you talk about growing, you want to grow, but let's say you're doing $1 million a year in revenue, or $5 million a year. Let's say $5 million a year in revenue, and then you land one customer and he pays you $2 million. So now you're doing $7 million, but there's no way, there's no guarantee he's going to keep working with you. It's like, well,
Totally.
That's great. But as a buyer's perspective, it's like, well, I'm not sure I want to pay for that extra revenue, because what if that was a one-off project? And so, when you think about growing, you have to grow in a certain way that encapsulates the value that you want to get out of that, because otherwise you can go land that whale,
Yep.
but buyers won't pay for that.
Totally. And I think like this math doesn't apply to us, but from all the time we spent supporting individuals buying businesses with SBA loans, I think the whole concept of debt service coverage, when you walk an owner through the math that a buyer needs to do on their business, that seems to get across to them. It's kind of like a light bulb moment of like, okay, if this guy is going to put 80% of the purchase price through an SBA loan, and we're at a 1.5, call it, debt service coverage ratio. So he has a 50% buffer on how much earnings can drop before he's bankrupt on a personally guaranteed loan. Then they're like, oh, okay, if you jack the price up, that's going to come down, and it takes one customer leaving, and like that's not going to be a fun conversation when you put a lien on your home. And so like once you start to understand the kind of math behind the scenes, these are rarely all cash buyers showing up, and like it's not real estate. These people aren't doing a 1031 exchange into your property. They're putting debt on it. They're putting all their savings into it, and this has to work.
No, and I have told many owners that, especially in the SBA range, go talk to an SBA loan broker or an SBA bank. Probably not your local bank, because they probably don't do a lot of them, but go find someone who does. I can send you some, and let them tell you what they will give a loan for on your business. Because oddly enough, owners, they know how banks work, and
Yeah.
so if the banker says it's worth 3.1, they might not want 3.1, they might want 7.5, but they know now, oh, okay, the bank's only gonna lend this much, and maybe you can squeeze 3.3 and whatever, but
Sure.
they kind of know, okay, hey, and that really I've seen with owners has been really effective, because when the bank tells them, I will lend this much money on your business, they now know, okay, that's just kind of is what it
Yeah.
is. And so They might love the number, might hate the number, but they kind of know
Sure.
it is what it is. And they don't feel like um, the buyer's trying to get over on them because the buyer's trying
Right.
to undercut them because the bank's saying this is what I'll do. And so I think that's an effective way for owners to at least understand. Oh, okay, this is where I'm at right now.
Totally. And an owner can always decide, I want to go unicorn hunting. Like, let's go find the whale who wants my business more than anything else in this world. And there'll be instances where that person exists and they want your business more than anything else in the world, and they're going to pay more than someone else. But as an owner, you have to weigh the trade-offs of like, am I going to play that game? And may come up empty-handed and just burned, 12 or 18 months when I'm near retirement, or do I want to go for a slightly more likely outcome? And at the end of the day, it's a completely personal decision.
Yeah, I need to put this out because I've got a list of things that owners need to decide and then rank. And like it could be the amount of cash you get on day of closing. It could be how your staff's taken care of. Everything is going to depend on the owner, but understanding
Yeah.
before you go to this process, what is your top priority, and then how much does that weigh over your second priority, your third, and so on. That really is helpful. If you don't know that stuff, you start having these battles going, oh, well, what about this and what about this? And if your main thing was the most cash on the day of closing, well, that might affect your valuation, right? Because someone might go, well, okay, I'll pay you more cash, but I'm going to lower that price down some because now I'm
Oh,
taking some more
totally.
risk, right? But if
Totally.
you're okay with, I'll take 2.5 now and a 2.5 earn out over 3 years. Okay, well, you might
Sure.
get a better valuation. And so owners really have to understand what is their top priority and how important is it compared to their other priorities before they go to market, or they will have a conflict with themselves when this process is going on over what decision should they make, and that list is really helpful for them to go back to.
100%. Yeah. And it's important to think through. And I think ranking them, we used to do that back in the kind of brokerage days. Because if you ask folks, do you want cash at close? Does purchase price matter? Does who the successor is? Of course, they'll say all of it, all the above. But unfortunately, it's kind of hard to operate with all the above. And at the end of the day, you got to make your priorities and stick with them.
Yeah, no, yeah, that you do. Okay, so how many? Out of curiosity, how many businesses are you guys trying to buy a year?
Next this upcoming year, probably around 40 or so.
40. Wow.
Um,
Okay, that's a lot of
yeah,
that's a lot of cash on the balance sheet, man. Congrats. That's
and
awesome.
credit. Yeah, and
Okay,
credit.
credit. Yeah,
So,
yeah, yeah.
the kind of our near term waypoint is to hit 7 by end of March. Then kind of ramp from there. So, and
Okay.
we're anywhere in continental US. We end up winning. Where we absolutely clean up shop is if you have a business in bumfuck nowhere. Uh, we're the people, because there you're oftentimes, the individuals who are local, who would be good to run the business, are cash poor. The money buyers aren't anywhere nearby, and they need someone to own or operate the business. And so we can kind of bring the best of both worlds together.
Okay, so let's say you called me uh, January 2nd, and you said, "Hey, Ryan, I want to buy your business," and I sent you
Yeah.
over the financials, and it looked good. Just generally speaking, how long does the process with you guys take from the time that we first meet to closing on average?
Let's skip to the time you sign an LOI with us.
Yeah, sure.
That is around 50 days.
Okay,
So we're
so
we're,
50
we're
days.
fast, and the reason for that is like we're not contingent on bank financing or investor financing. We have form docs that we've banged into shape that are very market, from 99 soon to be 100 small business transactions, and we have a locked and loaded team, so we can move fast there. The question becomes, before that, at that first conversation to when we countersign an LOI, like how long are those negotiations? And that gets back to the things you were alluding to earlier, where if there's like a lot of risk in the business, it may take us a little bit longer to wrap our head around, okay, what in terms of the go to zero risk, what does that look like? Why would it go to zero? Are there any things that we can do with the owner to kind of mitigate some of that risk? And then some of them are like, hey, I want to have a process, and have a process. If you want to kind of do an auction, that's your right. Other folks are like, hey, I like your values. I like what you stand for. I'm ready to go. So kind of varies.
Okay, so we talk on January 2nd, and let's just say this hypothetical July 1st we close. Okay, so what are you doing that's going to try to strengthen these companies that maybe you're not seeing enough owners doing already, so that when you go to, I guess, exit at some point, these, I don't know if that's going to be to that main operator or how you're going to handle that, but what are some of the things that you're doing, knowing what you know, so that you're maximizing the value of these companies? Because I'm guessing if they're in the middle of nowhere, it's not scale to the moon. It's going to be to
Yeah.
get a premium value of these companies to make them run really well. Maybe some SOPs, stuff like that. What are some of the things you're doing?
Yeah. So I'd say 30 days before an acquisition closes, we have a team that we call owner success. And they essentially parachute in to set up everything that goes into action on day one. And so that is, standardized chart of accounts, QBO, modern banking stack, reporting lines, getting our bookkeeping and tax partners spun up with accrual accounting, with monthly closes of the books. Everything that we need so that we have like a clean pulse on, okay, exactly what's going on here. What are our internal covenants, risk rating of the business? And we can kind of set a really good operating budget and annual plan based on that. Um, so I would say like those two things alone, like run the books well. And you don't have, this is not a ton of money. Like do accrual accounting, pay some bookkeeper and an accountant, get an accountant to set up the chart of accounts, get a bookkeeper to come in and close the books and do accrual accounting. That alone will boost the value of your business, and you're going to be paying a couple $100 more than you do today a month to do it. So it's not a huge investment. Second piece is put together some type of annual operating budget and plan and try to hit it and just take the business seriously. So I would say that's kind of on the financial side. The other areas that we lean in is each business, we bring in a current or retired owner from that industry to sit on our board of managers and be an advisor to the operator that we back. Idea there is they've been in the trenches, they can see around corners, they can help them think through scaling, hiring, people issues, customer issues, so on and so forth. A lot of the owners near retirement, obviously they have been around the block and they know their industries extremely well. There is a decent chance that getting some advisor around the table to help them think through, okay, how can I get this thing ready to sell? What are the big initiatives we should invest in? Is money well spent? And for us, we actually don't even pay the advisor cash. We position it in two ways. We say, hey, you're the only individual outside of American Operator who's going to be able to directly invest into the company. And that is an opportunity. So you reverse the sales pitch. And then two is we're going to give you a small profit interest in the LLC. And if things go well, that hopefully will be worth a lot of money. As a retiring owner, what my plan is going to be like, hey, I'm going to try to bring an advisor and say, hey, if you want to put a little bit of money and back some of these growth initiatives, do it, and I'll let you invest into the company. And then you've, instead of paying them all cash, you've now converted them into a partner there that's fully aligned. And so that helps a lot. And I would say the other two or three areas that we end up getting our hands dirty is on hiring. We're really good at that. Marketing. So any type of like outbound sales or marketing motion, we offer resources there, and we don't force our operators to use us. Like we're not trying to tell them how to run the business. Our goal is when we're really, really good at something, we're going to let you know and feel free to use us, but we're not going to force you. And if we don't know something, we're the first people to tell you because the last thing we want to do is like lead you astray. And so those are some of those services.
Okay, and that's great because all those things you just mentioned. Of course, if you're an owner listening to this, you don't have to do everything, but that mentality that you just laid out is what more owners, especially in that buy box that you mentioned, need to hear because they can
Yeah.
get more money for their business by doing those things. Okay, so you come in and you buy the company July 2nd. How long does it take for that actual new value to show up though? Because that's what gets missed a lot. Is like, oh, we made these changes, now pay us for it. It's like, well, no, there's got to be some
Yeah.
time under the tires, some tread off the tires, if you will,
Yeah.
to show that it's actually working.
For sure. I would say before I answer that question, the one thing I would add is that like if you watch the Olympics when people are running some type of race, the last leg, they pick up the clip like nobody's business. And so like as an owner, when you're in your last leg, you don't need to grow like crazy, but pick up the clip that you're like investing in the business because it's gonna pay off. And it's just like the final mile. Just put it in. It sucks, but whatever. You're close to the finish line. Don't just like slow down and throw in the towel and phone it in. But yeah, I mean, most of the acquisitions from a performance perspective go through a J curve. It normally earnings dip the first year, and it takes around 18 months for it to recover. And in fact, the ironic pattern that we see the most is that during the first year, revenue actually grows, but your expenses grow faster. And so you're seeing like a 10% loss or a 10% decline in EBITDA. And that's because of a couple of things. One is you got fresh blood in the business. Maybe they want to roll out Service Titan to the HVAC contractor, or maybe they want to do some new ERP if it's in distribution or whatever. So you get those kind of upfront fixed investments into the business. The second thing, which is the ironic part, and owners will appreciate this, is that as soon as there's a new owner in the business, oftentimes employees smell blood in the water, and they can kind of play Captain Phillips and say, "Give me a raise or I'm walking." And so you get a little bit of kind of payroll increase that first year, and then they get their feet under them, and then you can start to see earnings growth in the second and third year.
Do you guys advise the operators who are taking over after you bought, like how to retain that top talent? Because that is so important, because at these size companies, key man risk is real. And so you have a best practices that you say, hey, you should do this?
Yeah, yes and no. Like I would say it probably comes down to three things. One is that the reason we built American Operator was because we saw so many individual buyers trying to be the successor of local businesses that they knew nothing about. And so what we're doing is backing the Americans who deserve to become the owners who put 10, 15 years in the industry. And I think just that alone creates a lot more respect between the operator we backed and the employees and customers than someone who left being a project manager at Verizon last week. So I think that's kind of thing one. Thing two is when we interview, we have those advisors help us interview. They sit on the operator selection committee, and character and personality matters a lot. You don't want someone who's going to show up and start barking orders, speaking over people, telling people how to do it. Even if you're like, hey, day one, that's a problem, write it down. You don't have to immediately touch it. Just write it down. Keep on reprioritizing that list. And then like once things have kind of, you gotten your feet under yourself, you can start making some changes. And so we look for folks who embody that. That's why we often work with a ton of veterans. Like a lot of the veterans, whether they're enlisted or warrant officers or whatnot, they know kind of like when to speak up and when to bite their tongue and when to kind of do the quiet leadership. And I think that matters a lot. And then on the actual like tactics, I think there's a couple of things. One is if people are under market comp, increase it day one, immediate loyalty. So, and you see that a lot, especially in like manufacturing where your average employee is probably quite old. Like we've seen deals where the average employee is like 60 years old. And so if that's the case, they probably are kind of under market and they could be near the end of their working career. So like just go ahead and bump them up to market and pencil that into the math before the deal even closes. The second thing is that when employees ask for a raise, do not have a case-by-case reactive response. Think ahead of time and make a plan of what you're going to do and just stick to it. So for instance, we recently closed the deal in painting, and the operator and advisor were kind of gaming out like, okay, when folks want to raise, what do we do? The operator we backed wants to expand into another home services vertical. And so the game plan is, hey, if you come and ask for a raise, we'll give it to you, but only if you get trained in this other like related install category. And so there he can kind of get the best of both worlds. Like he can start planning for where he wants to expand in the future. So he's not just giving raises for raises sake, but he's also giving them something that they asked for. And so I think it's those types of things where like, hey, if people demand a raise, what are you going to ask in return? It can't be, oh, please just stick around and you're giving out ransom money, because there's a reason we have the don't negotiate with a terrorist approach to the hostage negotiations. Normally just leads to more ransoms.
Yeah, and it reminds me, because I talked to an owner one time, or a buyer. They'd bought a company, and I think it was operations, and they were really frustrated because the former owners didn't have SOPs and stuff, and they got in there, and two employees were doing a lot of overlap, and I said, well, you just need to sit down and ask why they're doing it, because I get it's a problem, but you need to understand they're doing a lot of stuff, and they're not going to tell you everything involved because they just do this every day. So they're going to give you 14 reasons why they're doing it. and this person give you 14 reasons, and then you guys start connecting. Oh, wait, if I start moving this around, because it works now. I'm not saying it's the
Totally.
best, but it works. And so you got to understand why it works before you deconstruct it and improve it, because it works. I used to have
Yeah.
people come to my company like, oh, we need to change all this stuff. I'm like, yes, but we're slammed right now. Okay, we
Yeah.
can do better, but we are slammed right now. We can't just scrap all this and start over. And I think a lot of buyers, especially that corporate mentality, they go to some program, they want to come buy a business, they want to come in and it's like, nah, that ain't this world, man. This is not how this
Totally.
world works.
Totally. And like these are living, breathing, I think of them as like organisms, these companies. I mean, they are a product of a small group of people working towards a mission. And so the other thing that you can do if you're not careful is if you piss someone off who everyone there likes, you're going to have flight risk. And that's how you go to zero real quick. And so you don't want to, be a pushover, but you also need to recognize these people have been working together for years, sometimes decades, and lecturing someone on how to do something that they've been doing for 20 years normally isn't a recipe for making friends.
Yeah, the other thing I'll say is don't mention the word EBITDA. Don't mention the word
Yeah,
EBITDA.
yeah,
Just don't
exactly.
even, no one knows what it means. Don't bring it
Yeah,
up. They don't care. You don't
totally.
sound smart. You sound like a jerk. Just don't mention that
Yeah,
word on site
yeah,
ever.
yeah, for sure. Yeah, don't do that. I think Charlie Munger has some great quote on it.
Oh,
It's a
does he?
bullshit word anyway. Yeah,
Oh
he's
yeah,
not a
yeah,
fan
yeah, yeah. No, he doesn't like
of
it. Yeah, yeah, yeah.
that.
But I've talked to a few of those buyers, and they're like, "Oh, we gotta talk about EBITDA." I'm like, these owners, they don't know what that
Yeah,
is, nor do they care. They're talking about their second
yeah,
lake house. That's what they care
yeah,
about.
totally,
Like, not,
totally.
not not that stuff. And
Yeah.
so,
And you can still be like driven. It just has to be on like the operational KPIs that matter, like win rate and the bids and all that type of stuff, not your fancy schmancy financial stat.
yeah, yeah. Well, it's a thing of, and it's really hard because the owner rightfully has pride in what they've built. They've worked really hard, blood, sweat, and tears, missed vacations and family outings and all this stuff, stress over payroll. And so they're really stressed about what they've done, and they're very proud of it. And so if you come in with all your fancy schmancy Harvard MBA lingo and try to talk down to
Yeah.
them or their employees, it's like that's
It's
that's
not
not
it's not how you win.
that's not how you win. No, that's not how you
Yeah.
win. You might overpay for the business or whatever, or get the business and then go to zero, as you said. And it's like, no,
For
that's
sure.
not how you win. You've got to let these people know that you care. They are
Totally.
organisms. They
Yeah.
are.
And you need them rooting for you. I think like
Yes.
one of the other things that I appreciated over the years is that a lot of financial buyers will put a ton of work into pretty complicated purchase agreements. And my model for it all is mental model is that um, very rarely is it going to make sense for you to litigate. And so, if they did something and you feel like, oh, they slighted me and that's worth $100,000, you're not going to go after the owner because the owner can shoot one text off to a couple employees still there and a couple of customers still there, and you're game over. And now, technically, they're not allowed to do that, but good luck proving it, and good luck, getting money back if you just went bankrupt. And so, you want them to be rooting for you because it can just go such a long way. And like what you said is true. Like they're the pinnacle of the American dream. Like they built something, a value that their community values. They're the people that step in when shit hits the fan back home, whether it's disasters or volunteering or whatnot. It's not big corporate America. They've created jobs and wealth for the community, and so you need to appreciate that and not lose sight of it.
Yeah. My advice is and always will be, I'm a redneck, so I can say this: speak redneck to redneck. Like I
Yeah,
want to go in
exactly.
the room. I might be smarter than them. I might be dumber than them. I don't know, but I'm just a redneck anyway. So I'm going to talk like a redneck. We're gonna keep this thing yoked,
Totally.
baby.
Yeah,
because
yeah.
people
And they're
because they love.
smart, right?
Oh yeah, yeah. I'm not saying that
Yeah,
I
yeah,
don't know if I'm smarter than them or not. I don't have to pretend to be. I'm just a redneck in general. So I'm just I
yeah.
don't want to talk
Totally,
about EBITDA and all advanced metrics. I want to talk about net. How much you make
for
last
sure.
year, because that's speaking their language, right? That's speaking their
Yeah.
language. And if they do understand the higher financial modeling and all that stuff, then they feel like they're really smart. And if they don't, I didn't make them feel stupid, because at the end of the day, they have a very successful entity. right? So
Yeah.
I can tell them all these fancy terms, and they don't know that, and KPIs they should have, and like, oh, I'm really cool and smart. But guess
Totally.
what? They've got 2 lake houses. Okay, so
Yeah. Yeah. Totally.
they got something going for them. But I think a lot of the corporate buyers kind of miss that. Like they do have 2 lake houses for a reason, and you
Yeah.
don't have any,
Yeah. Yeah.
so they
For
have
sure.
something.
For sure. Yeah. Yeah. I mean, I'm always like, I remember back home, a family friend has a farm where they grow like soybeans and stuff, and I was always amused that they're also one of the most sophisticated financial operations. You would never guess it in a million years, but they're like hedging with like futures on the commodity markets on like, if a hurricane comes in and wrecks Eastern North Carolina. But like if you drove by, you'd never think that, it's like, it's just,
Yeah, no, it's yeah. You don't just go in, talk like a good old boy. I'm just a redneck anyways, and talk, and maybe
yeah,
they understand more than you. Maybe they don't. It doesn't matter if you just talk to them like they're a normal human, just like you would
totally,
someone at the football game on Saturday. You just talk to them about
totally.
whatever. It's so much easier to connect that way than trying to sound really smart. Because honestly, what I've learned is that the owners don't care how smart you are on all this finance and metrics and stuff. They care more, it seems, how much you care about their business because they really care about that, and they want to make
Yeah,
sure they get paid a lot. I'm not diminishing that. They may have
sure.
some wonky theories on that, but they want to make sure that they kind of they I think they overestimate how long people will remember that they owned it, And so in their
Yeah,
mind, they're thinking
yeah,
7 years from now, everyone's going to think about me. Well, no one is,
sure,
but in their mind, they are. And so if you come
sure.
in there talking about all these changes you're going to make, their world is 7 years from now. People are going to think that Ryan did all this stuff, and no one will.
Yeah,
Everybody's going to forget. And
totally.
so you have to kind of realize that no, you need to care about this business because they view that as people will remember them, and the reality is they won't. But in their mind, it's really important. So
Sure,
don't go burst that bubble.
sure.
Protect that bubble for them.
Yeah, and like, we've had instances where an owner has sold out to some, finance shop who didn't treat folks right. And I know of one owner who had to change his personal cell phone number because folks were calling him so much about it. So like some of the fear is well founded. And I think the other thing is that if you're someone thinking about buying one of these businesses, what you talk about shows what you care about or what you think is important. And if you're talking about the finances, the owner's fear is like, oh, but they're not talking about the employees and why people still work here or why people choose to work with us when we're bidding on projects. And so they don't actually have what's most important top of mind. So just kind of know how you're coming across would be a piece of advice.
Yeah, and just listen to the owner. Let them talk.
Yeah.
Right?
Yeah. Yeah.
Yeah,
A lot of them will talk a lot. So,
they'll
they
talk a
got some
lot.
more stories.
They've got a lot of war stories. They're very proud of it, and it's one of those things where it's like, okay, how do you educate the owners on how to make it more valuable to sell? And some of the stuff that resonates with them does have value, right? In some communities, being whatever company the soccer games are sponsored by and the signs are up, okay, that does carry some value. And some it doesn't, right? But in their mind it does. So you really got to listen to them on what the value are, what their
Yeah.
values are, and how they view it. Because if you don't, and you focus on you know, the money metrics as you mentioned, and that
Sure.
they got plenty of money. They're like, I want to sell it for $2 million, but if I don't, I mean, I've talked to people
Yeah.
like that. Like they're like, yeah,
Yeah.
I'd like to sell for a couple
Whatever.
million bucks, but
Yeah.
if I don't, whatever, it's no big deal. It's like, oh,
Yeah.
okay,
Yeah.
you're doing pretty well then. Yeah, I am.
Yeah.
Okay,
You're not too worried.
you're not too worried. And I don't think a lot of especially those corporate buyers, they get that mentality either. Like, oh, okay, it'd be nice to
Right.
sell, but I don't have
Yeah,
to.
you got to win it, especially if you're not
Yeah,
going through a broker. Those people don't have high intent on selling now. You got to prove to them why they should. So, but yeah, it's a fun market, and I think one of the fun things about this space for all the brain damage you get along the way is it's all about the people, and the people are
yeah,
what makes the country special and what makes this space pretty never dull
yeah.
moment.
Well, that's why I kind of like what you guys are doing because I love dealing with owners. That's my favorite. I've dealt with the corporate project managers, and
Sure.
I sat in a room one time, and it was 2 people. One was our boss. One was, I guess, their boss, but from a different department. Like, and they just sat there for like 45 minutes arguing, not even arguing, debating over what to do, and it wasn't really hard. And I was like, well what if we just did this? I'm like, yeah, that's what we're gonna do. And I was like, I left the meeting. I'm like, like they are way more versed in this than me.
Sure.
So it must be some kind of corporate battle of
Yeah.
responsibility or something. But with
Right.
owners, you don't have to deal with that, right? And so I love
Oh,
dealing with owners, not that corporate
yeah.
nonsense. I don't miss that world at all. So I really like that you guys are dealing with especially small businesses, because
Yeah.
those are some great people. Okay, so if someone's listening, you know what? Maybe I do want to sell. Maybe I am kind of in a remote area. How can they learn more about what you guys got going on?
Yeah, check out americanoperator.com and it will walk you through how our model works, what we stand for, what our values are, and how you can get started. And there's a form on the site you can fill out, and one of our team members will get in touch with you. And you can also email us. I think it's like successor@americanoperator.com. And happy to hop on the phone. And we also like building relationships with folks early. So if it's, not a near term thing, but you want to start getting the gears turning, don't be a stranger.
And I would say I'd order one of these hats, but my head is so big. It's unfortunate because I love hats, and like it's hard to find hats that fit my noggin.
All
It's
right. Well,
depressing.
I'll shoot you one and you can double check. And then I'll also send you one of the bats. The bats are hilarious.
The
I don't
bat.
know if you
Oh,
saw that.
okay. Yes. That's
It
awesome.
says
That's
not for
awesome.
baseball. It's, you can defend against the private equity guys who come to your
Oh, I
shop.
love that. Yes, I see it. The bat's awesome. That's awesome. Okay, well, listen, I will never say no to a free gift. So thank you. That's really kind.
Yeah.
But
Yeah.
I was just checking out your site where you're talking. I saw the hat. I was like, man, I'd like that hat. But seriously, I've just got a large cranium. It is, and I love hats. It's just so depressing. So awesome. Well, Will, thank you so much for your time today, man, and best of luck in
Anytime.
2026 for you guys.
You as well.